All right, let's just jump right in because what we're looking at today is, well, it's one of the biggest financial mysteries we've seen in years. We're talking about a total breakdown of the world's #1 safe haven asset, and it happened smack in the middle of a major crisis.
So here's the big question, right? The paradox that's got everyone totally confused. For as long as anyone can remember, the rule has been super simple. War breaks out, you buy gold. But in March of 2026, with a massive conflict kicking off in the Middle East, the complete opposite happened. I mean, the old rule book wasn't just thrown out, it was lit on fire.
And look, this wasn't just some small dip. We're talking about a massive, brutal 15% crash in 1 week. To give you some perspective on that, gold's average return for an entire year is around 8%. So in just 5 days, the market wiped out almost 2 years' worth of normal gains. It was absolutely historic.
So, how in the world do we make sense of this? Well, here's how we're going to tackle it. First, we'll look at the crash itself. Then, we'll untangle that big macro paradox. We'll dig into the rise of digital gold, which was like pouring fuel on the fire. We'll cover the hidden risks, look at the bull versus bear case, and finally, we'll pinpoint the big catalyst to watch.
All right, section 1. Let's start with the basics, get our facts straight. What exactly went down during that totally chaotic week? Okay, so check this out, because the speed of this reversal is just wild. On Monday, March 17th, gold did exactly what it was supposed to do. Tensions flared up in Hormuz, and boom, gold spiked to over $5,100 an ounce. But then, just 24 hours later, the Fed steps in. They hold rates. And this is the key part. They signal only one rate cut for the rest of the year. That was it. That was the trigger. The price just fell through the floor, crashing below $5,000, and the selling just wouldn't stop, all the way down to $4,400. We're talking a $700 drop in just a few days. Insane. And this wasn't just random panic selling. The data, the charts, they were all flashing bright red warning signs. I mean, look at this. Your MACD, which is all about momentum, the most bearish it had been in months. The CRSI, which tells you if something's oversold, it was screaming extreme oversold. Even the alligator indicator confirmed a clear, confirmed downtrend. The technicals were basically shouting from the rooftops that this was a violent, full-blown collapse. Okay, so that brings us to the core of this whole thing, the big paradox we need to unravel. Why on earth did a major war, something that's supposed to be good for gold, end up tanking it?
The answer, it turns out, is a super fast 3-step chain reaction. Think of it like dominoes falling. First, the conflict causes a huge oil shock. Prices go through the roof. That immediately leads to step 2, massive inflation fears. Suddenly, everyone's worried about the high cost of energy bleeding into everything else. And that forces step 3. The Fed has to get hawkish. They see the inflation risk and basically say, nope, we're keeping rates higher for longer to fight this. And right there, that's the solution to the paradox. See, gold loves it when interest rates are falling and the dollar is getting weaker. But the war-driven oil shock did the exact opposite. It forced the Fed to stay hawkish, which kept rates high and made the dollar strong. So get this. The war premium, the very thing that should have sent gold to the moon, became the very thing that completely destroyed its price. It's totally counterintuitive.
But it wasn't just the macro story. There's another huge piece to this puzzle. The way people were trading gold had totally changed, and that's what really threw gasoline on the fire. We have to talk about the rise of so-called digital gold. So what is this stuff? Well, tokenized gold, or XAUT, as it's often called, is basically a crypto token that works like a digital claim check. Each token represents 1 ounce of real, physical gold that's supposedly sitting in a super secure vault somewhere. The idea is simple. You get the stability of gold, but with the speed and convenience of crypto.
And you can immediately see why this became so popular, right? Physical gold is, well, it's a pain. It's slow to sell. You can't just shave off a few bucks worth, and storing it securely costs a fortune. Tokenized gold just fixes all of that. You can trade it 24/7 on your phone, you can send tiny amounts anywhere in the world in seconds, and there are basically no storage costs. It's no wonder it absolutely exploded.
But you know how it goes in finance. There is no free lunch. All that digital convenience came with a whole new set of hidden risks, and a lot of people just totally overlooked them until it was way too late.
Which brings us to risk number 1, and it's maybe the most important question of all. When you own the token, do you really own the gold?
The short answer is nope, not directly. What you're holding is a digital IOU. It's a promise. You have to trust the issuer, like Tether, to actually have the gold they say they do. And then you also have to trust their custodian, like Brinks, to keep it safe. The audits they do are just a snapshot in time, not a real-time guarantee. It's all based on a chain of trust, which is the complete opposite of why you'd hold a gold bar yourself.
All right, here's the next big question. And this one really gets to the heart of why people even own assets like gold or crypto to begin with. And the answer is a resounding yes. See, these tokens have freeze and blacklist functions built right into their smart contracts. It's for legal compliance. So if law enforcement comes knocking, the issuer can just lock your funds. And that is a huge trade-off. You get the convenience, sure, but you give up that censorship resistance that makes physical gold or, say, Bitcoin so appealing.
And the last two risks are just as important. First, what's called a depeg. In a panic, the token can start trading for way less than the actual spot price of gold. And second, the redemption barrier. This idea that you can just swap your tokens for a physical gold bar, it's pretty much a fantasy for most people. You often need enough tokens for a whole 400-ounce bar, which means you'd need millions of dollars just to even ask for it. So after all that, the crash, these new digital risks, the million-dollar question is, where does gold go from here? Let's break down the bull case versus the bear case. Okay, so the bulls are saying, hey, the long-term story is still intact. Central banks are still buying it up like crazy, and the big banks are sticking with their huge price targets. They just see this as a painful but temporary shakeout. Now, the bears, they're pointing right back to those ugly charts we saw. They're saying the bull run was getting old anyway, and with a strong dollar and a hawkish Fed, there's just no way gold can rally from here. And this chart just shows you how massive that disagreement is. You've got the price today, totally crushed below $4,400. But then you have these huge banks like Deutsche Bank and JP Morgan still calling for $6,000, even $6,300. That gap between what the market is doing and what the big institutions are saying, it's huge. So what closes that gap? What are the big events that could flip this whole story around and actually prove the bulls right? Well, it really boils down to two key things to watch. First, any kind of ceasefire or major de-escalation in Iran. If that happens, oil prices would likely crash, inflation fears would fade, the dollar would weaken, and that's the perfect recipe for a massive gold rally. The second thing is any real sign of economic weakness. If unemployment starts ticking up or people stop spending, the Fed will have no choice but to pivot and start cutting rates. And historically, nothing is more bullish for gold than a Fed pivot. And that leaves us with the final big question. Was this a truly historic crash that signaled the end of the bull market? Or was it a historic buying opportunity for anyone brave enough to jump in? The answer really just depends on which of those two catalysts we just talked about happens first. Thanks for watching.